maybe we already have 20, 30 cents of war premium in that wheat market that we don't know right now.
Hi, everyone. This is Matthew Kruse. I'm filling in for Marlon Bowling this week, who is out on vacation. So with me, I got the trifecta, the tremendous three, Joe Camp, Eric Relf, Justin McKinney. Thank you guys for joining us. So I'm trying to get all hands on deck here and talk about these markets. So what are kind of the highlights that you're seeing right now? Maybe go around the horn and each person kind of pick out what's speaking to you right now and what's going on with the trade.
I think right now, I mean, the most notable is the pressure on the soybeans, and that's got to be relative to 170 million metric ton potential in Brazil, and conditions being just exactly cooperative throughout this growing season so far. It is young in the growing season, but I think that's a struggle, and that's probably standing out as much as anything. If not for that, I think the corn has every chance in the world to break out to the top side, just can't get it done with that weighing pressure from the beans.
That would be notable to me, the different directions these grains are headed in every other session. Today's included, with the soybeans, as mentioned, lower, but the grains, corn and wheat, higher within the soy complex itself. That's a big story for me. The different products moving around, and in this case, soybean oil back down sharply. So much attention having to be paid to soy oil right now. And last night it was palm oil breaking back lower. Last week it was the political influence of the EPA director and what's ahead for U.S. biofuel policy, the 45Z credit, you name it. We could bring in Indonesia and biodiesel programs expanding there. There's just a lot with the soybean oil in particular we got to keep an eye on.
I want to flip it over to the livestock market. You got the cattle on feed report coming out at the end of the week. Cash market's not doing anything yet this week, or anything helpful yet this week that I've seen. We dialed in some pretty bearish numbers on those cattle for the cattle on feed estimates. I wonder if we'll actually live up to that hype. It just seems that you get these huge numbers built into the market, and yet maybe we underperform on the numbers and the placements. So I do continue to hear that it's very, very tough to buy 8-weight to 1,000-weight heifers for guys looking to feed those. So I question whether those move to the feedlot early with the drought, or whether they are being retained. My personal bias is, if you're a rancher, you probably moved that into the feedlot or sold those calves off early. We saw big sale barn runs earlier this fall. It's pretty hard to retain those calves back when they're bringing that kind of price.
Going back to what Eric said on the soybeans, we've seen some pretty decent flash sales for exports, and it seemed to me like that's kind of kept our head above water a little bit. Do you think there's a chance that we could rally based on that? Because it seems to me I'm looking for something positive here to turn things around, and that's maybe the only thing I can really think of. But at the same time, not sure when are those sales taking place. Are they for next year, or is it China buying ahead of the incoming Trump inauguration? What do you think there?
That's what it feels like. I mean, it feels like they're front running some of these purchases, and it doesn't seem like traders are giving it much credit. It's almost like every day we don't have a daily flash sale, well, that's a bad day. And so they're expecting it on a daily basis. If they are front running these sales, I think there's a lot of anticipation that if Brazil does come through with the production that they're capable of this year, then a lot of these sales get canceled. If there isn't tariffs, if they don't have trade war, whatever develops over the next 4 months, until that Brazil crop is out of the ground, then who knows what these sales can actually mean, because they can cancel theirs. Whatever we do on the board, we're stuck with it, even if you're short coffee right now. So
it's kind of too little too late.
That's what the trade is acting like. I'm not saying that's the case, but that's the way the trade's treating it, at least from what I can see.
But, again, following up the cattle comment, the same thing with the soybeans, Eric. It's widely known that we've had 166 million metric ton, maybe up to 170 million metric ton coming in South America. Funds are continuing to sell beans in short. Meanwhile, we still have a big carry out here, and we built a large long fund position. So if you see those funds come into the market on any sort of positive news or weather story in South America, you could move this market in a hurry.
Well, it's buy the rumor, sell the fact, right? And that's one of my contentions with the cattle on feed report is with the buy into this that we've seen over the past week, are we setting ourselves up for disappointment? If we do get a neutral report, is that actually bearish the market because of the rally that we've seen here lately? So are we buying the idea and then we're going to sell the actual market after the day comes? I don't know. And the opposite could be true in the soybean.
Joe, you and I had discussed the fund positioning yesterday. I think that, how long has it been now? A year and a half where we've been net short in the corn, and now we've finally switched net long here. How much of a factor is that? And because we've been waiting for this, seems like for a long time. So is that a reason to get more positive?
It can be, and you can see evidence of the funds trying to defend these positions and use them to push this market to new highs, not far from new highs. Then again, for the move on corn, we should bring up, of course, that's the opposite of soybeans at the bottom end of their range, and the fund position is the opposite of that too, corn and soybeans, whereas yes, the commodity trading funds are net long in the corn market, over 100,000 contracts, the first time since the summer of 2023, but they're still moderate to heavily net short in the soybeans. And so what gives? I think one or the other, and that you can continue to have diverging prices, but not forever. And so the funds either flip to being back bearish because they're proven right generally about having all these worries about what's ahead after the first of the year with demand and everything else. And then, or it's the other way around and we have some problems in Brazil or enough continued export surprise that the soybean position turns bullish. And so that's what we're watching for.
It seems like so often that the corn market is highly correlated to the wheat. And I look at the wheat charts today and they don't inspire a lot of confidence. I mean, what can you tell us about the wheat market right now? Is that still heavily influenced by what's going on in Ukraine and those markets and the ongoing war there? Or, how much is U.S. production, still a factor in that?
That right there, I think, in my opinion, is the biggest possibility for a continued divergence between the grains and the soy complex that Joe mentioned earlier. You're not likely going to do that forever, but if there's more war premium to be had in the wheat market, that would really help the corn, and they could continue to go in opposite directions and stay divorced for a while. But there's a big if in there, right?
And the flip side of that, Eric, is maybe we already have 20, 30 cents of war premium in that wheat market that we don't know right now.
Very well could.
Going forward, let me first start out saying, this month here in the USDA report, we saw some major unexpected cuts to yield. Do you think the USDA could still make some more cuts? I mean, they can, it's not uncommon for them to make additional cuts out into January. Do you think that's still possible? Because they kind of got ahead of themselves, which was disappointing, where they were raising it up to above 184, and then they cut it quite a bit here now. And so you think maybe we'll see some more of that?
Kind of frustrating that they would seem late in the game. When you get up into November, of course, you got a lot of the harvest data, and that would be what they point to the being reason for adjustment late. Although I feel like that November report, a lot of it pretty well hidden within the election week and everything that would follow. And that's still the case probably coming into January. There's a lot more to talk about. There's a lot more to focus on, what's going on down in Brazil, et cetera. And so it's a shame that it comes late to where any other year it would seem to be a much bigger deal that we had that huge soybean cut in particular this month.
I think you look back, though, at 2019, where the USDA continued to kick the can down the road, and it didn't show up till a year later in the stocks report. If you're banking on a huge cut in January, I'm not so sure that's going to happen. But west of the Mississippi, the basis has been relatively firm. We're continuing to see pushes being paid at processors, and we're also seeing the accumulator contracts floating around again to try to originate deferred bushels with the premium offers. So all those things tied up, I look at a spread that's narrowed in about 50% from the highs, the December to the March corn. Do I think there could be a stocks adjustment coming later down the road? It sure feels like west of the Mississippi anyway.
On that note, I think it's worth mentioning because Justin just highlighted that spread. I mean, if you've got December longs that you're looking to roll, this is a premium opportunity compared to what we've been seeing in the last couple months. We narrowed that thing down to 9 cents today. That's just that's cheap storage, I guess, is my point.
Last year we saw that farmers held a lot more of their crop into the next season. Unfortunately, probably longer than they should have, and that was seemed like a big reason for the price continuing to deteriorate. And we typically see that when the farmer holds most inventory, that the price drops. Where do you see that happening out this year? Do you think farmers have learned from that mistake? Have they remained mostly sold or undersold? What are your thoughts on that?
Different this year so far, in my opinion. I'll start because I think that should have been the second part of my answer about what the funds are doing and how they're positioned, because they've taken the opposite side of the farmer selling throughout this harvest and the immediate post period. You have those spec longs being offset by a much bigger commercial net short position on corn than a year ago. We're talking about 5 or 6 times the amount. I mean, more than 1 billion bushels held net short by the commercial crowd right now is in some big representation a mirror of the farmer selling that's occurred to this point that did not occur a year ago. So for corn, that could be a relatively friendly thing going forward, at least not as negative as it was a year ago.
I think it's very regional though too, Joe. Where I live in Rochester, there's a ton of corn sold across the scales this fall. To back up your point, we saw some spike push bids at $4, things that wouldn't fit in the bin that did end up moving into the market. Now you move west of I-35, west towards Royal where Eric is, or even farther west. There seemed like there was plenty of storage there. I would venture to guess that direction, there's probably a fair amount of farmer-owned bushels out there yet. But I could be wrong. Time will tell. It just looks like that way where they had that much storage available.
I think there's definitely some of that in this region, especially somewhat localized. I mean, it was a decent sized area going up into central Minnesota and then south into the northwest quadrant of Iowa, go west from there. But the areas that flooded out, you had a lot of bin cleaning out, making room for the new crop, and the new crop wasn't there. If you cleared out space for 200,000 bushel, you only harvested 140. There you go.
You're kind of wrapping up here. If you guys are talking to farmers every day, if they're looking to get connected with some risk management, on unsold production, what do you tell them right now? What are some specific ideas or strategies that you kind of suggest that they consider?
I have been an advocate. You look at the March 440 puts. The market looks like it's trying to roll over. We could see some cuts or some stocks adjustments this winter. Could see some safrinha production problems. I like the 440 puts if you're risk tolerant enough to go sell some $5 calls above it, knowing that you would have your production sold at $5. I feel like that's a pretty good strategy on the old crop. Corn, soybeans. We're hitting any bids that get close to $10 on the cash. Looks like a long ways away today, but trying to get offers in place for that.
Yeah, my first question is consistently, what is a normal basis, right? And are we better than normal? If we can take advantage of some of that and subsidize a little bit of these sales with some sold calls out of the money, go ahead and go at it that way. If we think there's room for improvement on the cash side, then maybe we look at some future sales and again add some premium through sold calls. New crop I'm already starting to do a little bit of, because there's a lot of places where you could sell that December 25 board, sell some $5 calls above it, and with localized basis be $5 cash. So that kind of thing can be done.
I like those ideas. They fit just generally with what I'm talking with farmers about, which starts the same question: what's basis and position. And that can vary so differently, but you can get back to the same sort of strategy, which is hedge for higher volatility in the wrong direction in my mind. And so if you are sitting on a bunch of the last crop and it's unpriced, your worst case scenario is that this market does fall and fall and fall. And our latest price lows are 2019 and 2020. We're talking about $3 and $7.80. There's a long ways to go where it could get ugly, of course. And so what's your protection against the worst case, while still leaving your outlook open for possibly those higher prices? And that's what buying the puts does. It's what, making some eventually incremental cash sales does. And then, potentially hedging the other way, where you can move to cash and then have some of that to potentially re-own the board with here. So all that's going on, I look at the volatility a lot and think about what's still to come in terms of post-election, the inauguration, policy implementation, the risks with Israel and Iran and Russia and Ukraine, and the word nuclear, and you name it, and the things you can't think about make me want to be just generally long volatility as a protective hedge for what's still left of a lot of crop here.
Eric, I'll let you kind of wrap up here. Maybe give us a brief update on what's going on with LRP and maybe even PRF too, because I know the deadline for that is coming up here December 1st.
Yeah, December 1st, PRF deadline, pasture range, land and forage insurance. It's just rainfall insurance against all native grown. So all your hay operation, grazing operation, as well as alfalfa, all those products can be insured. And that's something that I think a lot of agents either aren't aware of or don't feel like it's something they want to put into their repertoire. So a lot of clients aren't aware of it. And I've had some clients that have switched agents because they weren't made aware of it for years and had a lot of insurable ground that was unprotected. So something to consider. We have had some really nice rains here. The hay production's been really good, but it doesn't always hold out. And we're due for Elwyn Taylor's 89 year on the money next year. So definitely a consideration. LRP, it was kind of funny. I had some calls yesterday because I had made comments to clients that we needed to be looking for that 257 to 260 range in the August feeder cattle. And we hit that yesterday. So I did have a few calls yesterday and put some LRP on this morning for those summer calves they're going to be in the 6-7 weights come late summer. So, there's things to look at and consider. It's deferred payment. Let them bankroll it, have the protection on, and see if we can't exceed current levels by next summer. We're in the hottest feeder cattle market that maybe we've ever had, and our index is at 254, and we can beat that number late summer in that August and September timeframe right now. So it's definitely something to consider.
Okay, Joe and Justin, anything else you want to add to anything that we've discussed today? Any final comments?
Call us. Let us know your individual situation. That's where we can talk more of the specifics. There's a lot going on. So,
Yep.
All righty. Well, thank you guys. You're awesome. I appreciate your time. Thank you everyone for watching. Feel free to subscribe to the Commstock channel.